Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello, good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, morning. How are we feeling this morning?
It's going to be a good day.
Well, for the last 1 week, I think we've been trying to sort of hunt for some kind of pullback in the market, but it hasn't come along. So let's see. Today's a new day.
Yeah, we start with optimism, right? I mean, no other way to do it. So let's do that. The market has been down and out for the last several trading sessions now, 8 to be precise. I'll get to that in a bit, but let's just pick up from where Wall Street left off in terms of a handoff. Not much of a handoff, frankly. It was a quiet session overnight. The S&P, it's kind of reminiscent of what happened day before yesterday. I mean, some of the stuff that we said yesterday, same time, I think can be repeated. Because, I mean, the S&P was up when we came into the session yesterday. It's down, but not material in that sense. Down about 0.3. Mastek is down about 0.1%. The price action in yields, that's the market, interest rates in the US and dollar is perhaps more significant. So US yields are pushing 3.93, 3.94, 3.95, right? But they're stalling a little bit. They're not taking out that 4% mark conclusively. In a way, this reminds me of what we saw perhaps in September, October 2018. Now, not drawing a direct parallel, but the fact is back then, similar kind of price action. Many thought that it'll break through, but it did not. Eventually, what happened was that as yields sort of threatened to break higher, stocks kept falling. It caused that much-awaited Fed pivot. But that is back in 2018, as they say, history does not repeat, but it does sometimes rhyme a little bit. Let's hope that is the case. No indication of that, frankly, but I just wanted to make that parallel because we are seeing a doubtful kind of price action. It's not pushing through. It should by now. It's not happened. Maybe it will. Now, the dollar index is the other one. It's inched back closer to the 105 kind of levels. So it's not there yet, but it's closer. So again, there is a bit of indecision which is happening there. I looked at the Asia dollar index, which is also, I mean, you know, the dollar index, the US dollar index is made up of, I mean, disproportionately large weightage of the euro. But if you look at the Asia dollar index, that has actually posted a bullish outside, it's posted a bearish outside month, which basically means perhaps more downside levels. It broke the 100.8 level. It perhaps means more downside pressure on the on that particular index, which means Asian foreign exchange, Asian emerging market currencies perhaps will see pressure. If this plays out, Asian emerging market currencies will see pressure, rupee included as well. Of course, I mean, with the rupee, what matters is the 25 basis point hike that many are expecting now, the RBI to do, and that perhaps supports the currency going forward. But something to keep in mind. Now, the Nifty here has, as I said, closed lower for the 8th consecutive session. It's not happened in a long time, but it has happened before. The index closed below its 200-day moving average. For some, this is the Lakshman Rekha between being bullish and being bearish. It's a long-term average, makes a difference. The support comes in, and we put this level out yesterday as well, comes in at the 20-month moving average. We closed above it. That stands at 17,272. But I mean, you know, we closed at just 30, 40 points above that level. But that does become a bit of an important level. The SGX is indicating that we perhaps start below this level. You know, it's a long-term moving average and has significance. Once it goes, I mean, you're basically looking at 17,000 kind of levels. I mean, supports come in around the 17,000 kind of levels. We'll see. Banks outperformed yesterday again. Nothing like what we saw day before yesterday. Bank Nifty was up 1% day before. Yesterday, it was down little, but it was down nevertheless. Resistance for the banks, the bank index comes in at the retracement level of the 5-day fall. I mean, the recent fall. So the first number is 40,509, not very far from where we are. The second is 40,790. And on the way down, 39,600 should not be violated if, I mean, the Bank Nifty has any chances, any luck of a pullback lingering around. So I think that's the setup as we start another session. As I've been saying, let the market tell you that it wants to turn around, it wants to base out. So far, despite the 7-8 days sort of fall, it's not told you that. And I think yesterday was a prime case, an example. Let the market do that. 50, 60, 100 points won't make a difference, but let it conclusively tell you that it perhaps has done what it needs to do on the downside and it is ready to move higher. Guys, hi.
Absolutely. I think it's prudent to stay cautious even now, right?
Yeah.
It doesn't mean that just because the market has fallen 8 days in a row, it won't fall another 8 days. And this is a situation where it is pretty unpredictable what's happening globally. Even the SGX Nifty this morning is indicating that the start will be well in the red, down almost about 25 odd points. And put together, if you look at of course, the global handovers week, even this morning, the Dow is down about 230 points. But the month of February has been alarmingly weak for the global markets, the US markets particularly. The Dow is down 4.5% almost, the S&P 500 down 2.6%. So there's a cascading fall that we've seen globally. And even for our own markets, the selling pressure is unabated. So FI is once again sold in excess of 4,500 crores yesterday. A couple of macro data points are also on the weaker side. So you have the Q4 GDP data in India that came out yesterday. Second consecutive quarter of a slowdown. The slowdown has come in at about 4.4%. We all know the concerns, higher inflation, waning demand. So that on the sidelines is another thing to worry about. And now, in the first 2 months of this year, the market cap of BSE companies has gone down by 25 lakh crores, and that's the steepest we have ever seen in a span of 2 months. So that's the kind of selling pressure that we've seen in this market. So clearly, the sell-on rally strategy is something that is playing out. There is no change in that up until now, and it is perhaps prudent to continue to stay cautious. There's a lot of delivery-based selling that we're seeing in large Nifty companies as well. Crude is once again back closer to $84 a barrel. So there doesn't seem to be any trigger that could take the markets higher. The only thing is Asia is having a good run this morning. Hang Seng is up 450 points. That's also because now they have removed that masking, due to COVID. Now masks are not required. So that the reopening trade, I guess, is something that's playing out in the Hong Kong markets right now. But stripped of that, this is a market that the texture has become extremely weak, and there is no reason for that to change, I guess, anytime soon.
Well, that's right, Sonia. But the bears, they have an eye on history. We have never seen 4 straight negative months in the last 20 years. So this time around, they're hoping that we have already had 3 months here on the Nifty. And they're hoping that maybe, in fact, they're looking to break that jinx. So let's see whether or not they are successful. For the time being, the odds are in favor of them. But I'll tell you what, the bears are getting very, very confident and maybe a little bit overconfident as well. So maybe today, maybe tomorrow, I think a relief rally is long due. Let's look at trade setup then. Yesterday, the gross volumes, well, they were high, the FI gross volumes, but that's because of the MSCI rejig. So just take that on board. Risk reward could favor the bulls and may not be very beneficial for the bears, given that the SGX Nifty is suggesting a 50-point downtake. And if we can hold on to that 17,200 odd mark, that'll be good news. And I say this because the PCR has moved to around 0.67. The FI short positioning has moved to around 85% odd. Well, and what's been batting for the bulls in the last few days has been the Nifty Bank. Just take a look at that. The last few days, the Nifty Bank has done pretty well. It's outperformed the Nifty by close to around 2%. You like that to continue because the Nifty Bank, if that can bat for the bulls, then we can see a bit of a recovery. What are the FIs doing in the FNO market? Well, they added close to 13,000 short contracts out. Now the net short positioning is more than 1.3 lakh contracts. That's a large number. That means that the short positioning is at around 85%. On the index option side, you'll say they bought some calls. The problem is they continue to write calls very, very aggressively. And even in yesterday's trading session, the 17,400, 17,300 calls, both of them added close to around 85 lakh shares odd. So there is aggressive writing at those levels. And the 17,400 call, the rough premium would be around 50 rupees. And if you look at the 17,300 call as well, the average premium was around 140 rupees. So you plug in the numbers, you get the resistance zone. They are looking to defend the 17,450 to around 17,500. 17,200, 17,250. We bounced off the 17,250 yesterday. So that's going to be very, very important. But the Nifty Bank has been in fine form. So it needs to hold on to the recent lows. That's the Feb 1st as well as the Feb 27th lows. You like the SGX Nifty to actually open a little bit deeper, suggesting the Nifty. For the time being, it's rebounded from the lows. But if we open with a gap down, it will not be such a bad thing from a bullish perspective. That's the call.
Nigel, yesterday we had Vikash Kumar Jain. I think he put it quite nicely.
It's not over bearish.
Yeah, he said, it's lighter, but not bearish. It's not outright bearish. And sometimes you need sentiment to really get, this is going, that kind of thing, for things to turn around. And I thought that was a kind of nice way to describe where we are at right now. But, bounces will come.
May not be sustainable, but I think maybe in the near term we're due for a bit of a bounce. But I was speaking to a couple of fund managers yesterday, and they said the next 6 months may be the best time to start studying a lot of stocks, because we may move sideways, we may see a sharp correction, and that could provide the best entry opportunity from a longer term perspective. So let's see whether that plays out.
Yeah, I mean, no time to study, right? I mean, in a bull market, actually, it is crazy. If you guys remember 2000, I mean,
everything flies off the shelf. Yeah.
Before you start talking about a name, it's up 15-20%. So you're kind of breathless catching up, which is not the case now, which is perhaps the silver lining here. Well, before we get any further, let me quickly tell you what is lined up here over the next 30 minutes or so of the show. We'll get you updates from across the globe. Mark Matthews of Bank Julius Baer and Company will join in to discuss the global trade setup. Our research team will bring you our list of top 10 stocks to watch for the day. And we'll have Devin Choksi of KR Choksi for some fundamental stock talk.
All right, and let's get you some equity calls now. On the equity side, first up, Jonathan Garner of Morgan Stanley says that the MSCI Emerging Markets Index has corrected 8% from its late January peak, with the catalyst being a stronger US dollar and somewhat higher real rates. He says this reestablishes a significant upside of a 14% December 2023 target. He adds the China NPC meeting is due on March 4th to 5th. It is an upcoming catalyst at a time when China mobility indicators are surging back to pre-COVID levels. He adds it's noteworthy that Korea and Taiwan's corrections have been limited, with early cycle IT hardware continuing to outperform.
Okay, this is Gautam Dugar of Motilal Oswal Financial Services, who says the market is looking weak given weak macro data and sharp slowdown in consumption. He says till the time there is a positive trigger, it will remain in a range. He adds absolute valuations are now reasonable for the Nifty, and we like tech and auto, along with select consumption stocks like M&M, ITC, Titan and Metro Brands. He adds the problem with banks is ownership and a crowded trade, which is the problem with the financial services space.
Okay, I guess, what he really meant is that at banks, there is no fundamental problem. The earnings are very good. Valuations are not too demanding, but it was such a crowded trade that ownership is the only concern that he sees at the point. But let's get you some money market views and tell you what you can expect for today. For the rupee, Kunal Sudhani of Shinhan Bank says housing data in the US was mixed, though the markets mainly ignored it. Overall, softer US data, mixed geopolitical headline, challenge the dollar bulls with 105.5 as a resistance level. He further adds that upbeat European data contrasts hawkish Fed concerns as US PMI is awaited. For the dollar, INR 80 to 50 acts as a support, while 80 to 85 is a resistance.
On bonds, Neeraj Gambhir of Axis Bank weighs in. He says the 10-year benchmark bond yield traded in a range of between 7.36 and 7.44% last week. He says data continued to remain strong on the global front and our market movements mirrored global sentiment. He says weekly auction demand also remained muted on the lack of investor interest, particularly in the belly of the curve. He adds the coming week is light on data and markets should watch out for investor demand in the SDL auctions. He expects the 10-year benchmark bond yield to trade in a range of between 7.4 to 7.51%.
Well, we have a lot of stock-specific action for you, and we'll track to that in just a bit in our special Top 10 segment. We're looking at Axis Bank, Bombay Burma, Power Grid, MOIL, Federal Bank and HDFC. They are stocks on the back of positive news flow. While on the flip side, you have Delivery, Macrotech Developers, Oberoi Realty, and Keystone Realtors. They are stocks that could open up in the red.
All right, let's get you some sort of views. This is Goldman Sachs Chairman and CEO David Solomon on the inflation worry. He now sees a better chance of a soft landing. Listen in.
There's been a shift over the last 6 months. I think there was a lot of pessimism around the chance that we could get through this cycle without a real recession, given how quickly we were changing economic conditions. We've now been in a period of 9 months where we've had a real tightening of economic conditions. Obviously the impact of that will lag. We've taken inflation from double digits, down, more to 5, 6. I think the general consensus is inflation is going to be stickier. When I talk to CEOs, stickier and harder to move, from where it is now, down to 3%, let's say, let alone 2%. Right. And in the context of that, higher rates, longer, sluggish growth, stickier, but a better chance that we can muddle through with a softer landing. And so I think there's a little more optimism because people's businesses have been performing better.
Mark Matthews of Bank Julius Baer and Company is joining in now. Mark, great to have you with us here on the program. Thanks very much. I was sort of referring to the US 10-year, which is just under that 4% mark, hesitating, stalling. How would you look at that, the price action there? The dollar index is just around the 105 mark. You know, are we headed much higher on both these?
It is the million-dollar question, Prashant. That 4% level on the 10-year is extremely significant psychologically, and it does seem to have a tough time getting above there. The other 10-year to point out is the 2-year note, which is at 4.8%. So that's gone to a new high. The high in November last year was 4.7%. And that one, I think, is probably more important because the 2-year was the canary in the coal mine that signaled the end of the last 8 rate hike cycles. It peaked and rolled over a few weeks before the last rate hike of the previous rate hike cycles. So I am watching the 10-year at 4%. I hope it doesn't go above it, but it could. The more important thing, I think, is that the 2-year having broken to a new high, well, at least the highest since 2007, is signaling we have a few more rate hikes ahead of us. And so once again, you know, can the market handle that? Just referring to the previous comments from Goldman Sachs CEO, I think it can, because on balance, if we do have higher rates, but it's because the economy's strong, then that's okay. And I also will say one last thing, which is that the January numbers really surprised to the upside. And I think that surprise will fade because the consumption in January was probably skewed by much warmer than normal weather. And so if you believe that to be the case and the data does fade a little bit, then people won't worry so much about higher rates. But at the same time, they were not worrying so much about a recession either. Then I think we're okay.
Okay. Mark, hi, good morning. As you said, you know, perhaps the markets can withstand a little more, but how much is too much, right? Because it's been relentless, the kind of selling pressure that we've seen in the markets. I mean, the Dow is down over 4% in just the month of February. Do you think all of the bad news is in the price, or do you see more downsides for both global and Indian markets now?
Well, Sonia, yes, the Dow was down in February, but I don't know about the Dow so far this year, but the S&P is up about 4% in January and February. And if you were to annualize that, it's a return of around 25%, which of course is fantastic. And I would say it's not impossible. We are entering into a sort of seasonally soft period now, March, April, May. But I still feel that the shelter component of the CPI and PCE baskets will start to decelerate. We've seen very obvious softness in the real property prices, and it takes a time for that to be reflected in the inflation data, but it will. And at the same time, commodities have been very well behaved. On balance, I think the market can handle 2 more rate hikes. Maybe after 3, that would start to be a problem. Yeah, so I still think we can have a good year this year.
Oh, interesting. And what about for the Indian markets, Mark? Can we, you know, we are on a 8-session losing streak. We haven't seen that in a while. We've been relative underperformers. Do you think that maybe we can bounce back in the latter part of this year?
I certainly do. I mean, India, like all markets, is driven by sentiment to some degree. And nobody likes to see their portfolio down, and India's down so far this year. So the retail enthusiasm has waned. It has, like the rest of the world, the same headwind of these higher interest rates. But I do think the RBI is much closer to the end. And in fact, I think they'll probably pause now just to assess the weight of the 250 basis points of hikes they've already done over the next few months and see how that pans out. But of course, the thing that's the unfortunate thing about India is the Adani Group saga and how that might weigh on banks and in turn their lending to the rest of the private sector and whether that could cause some softness in the economy. I don't know the answer to that, actually, but I suspect it won't be the case. But the radio silence from SEBI and the government about the exposure of PSU banks to that company is another weight on the market.
Although, Mark, there is one aspect which is specifically the PSU exposure to the group. I think it's been kind of well laid out. It's about the total exposure is just under 1% to the banking, to the banking system, which is not that much, which is manageable, right? And that is the exposure, and the stress, of course, whatever it may be, will be much lesser in that sense. But take your point on board. Mark, what are you picking up in terms of flows with regards to China? I mean, about time the enthusiasm to China with the bounce we've seen from the October lows last year starts to fade a little bit? Or no, I mean, it's full steam.
Yeah, certainly there has been inflows into China from overseas so far this year on the equity side, not on the fixed income side, but there has been equity allocation into China. And I think most of that has been short covering. So real fundamental investing, there's not been a whole lot of it. And I think that the reason is, number one, people are still not quite sure that confidence toward the economy in China can recover quickly, given the devastating impact of zero COVID last year. And what I hear anecdotally from my friends in China is really a total loss of confidence, particularly in the urban areas among the educated people. And then also the geopolitical overlay, which I had hoped was getting better after the G20 meeting in Bali last November, but we all know it's not getting better. And so just this morning, the U.S. government was imposing fresh restrictions on doing business with Huawei, and the whole specter of more difficult economic relationship between China and the Western world continues to also hang over that market.
All right, we leave it at that. Thanks a lot, Mark. Always a pleasure speaking to you, and you kind of pour some medicine on the bull's wound, so to speak. You're not too pessimistic on the market. You think perhaps the market can handle 2 more rate hikes and things could get better from here. It's always great to hear. Thanks a lot for joining in. We'll speak to you again very soon. Let's slip into a quick break. On the other side of the break, our entire team will be joining us to tell us about all the stocks that you need to watch out for as we begin a brand new day of trade. Stay tuned. Welcome back, folks. It's been quite a week last couple of days, and now the market indication is that today is also going to be a day in the red. But let's see, at some point a pullback's got to come. Whether it comes today, a couple of days from now, time will tell. But the pullbacks that we've seen recently have been quite feeble and unconvincing, so maybe that could be the order of the next few days as well. But Abhishek is joining in to tell us the latest on Axis Bank. Abhishek, over to you.
Well, Sonia, Axis Bank has completed the acquisition of Citibank's India consumer business. So the transaction has costed them 11,603 crores. The earlier estimation given by them was about 12,325 crores. So a 700 crore odd saving over there. Now, CCI, that is Competition Commissioner, had already approved this deal in July 2022. What's in store for Axis Bank? They get 30 lakh customers from Citi's customer base. The card balance sheet can grow with an additional 25 lakh cards. The branch expansion will aid the loan growth. Citi Wealth and Private Banking has an AUM of over 1,10,000 crore. Deposit accretion about 50,000 crore or even more. Salary business of Axis Bank will strengthen post the deal, and the proposed transaction will add about 6.6% to the deposit base, along with 11.2% addition to the CASA or the low-cost deposits, and about 3.7% increase in the loan. So overall, strong business momentum can be seen from Axis Bank in their Q4 results. Back to you.
Okay, Abhishek, thanks a lot for that. Well, let's hop across to Nimesh. There's a large trade that he's been warning us about in delivery. That's a large trade that's due. Morning, Nimesh.
Morning, Nigel. So there is going to be a large block. SoftBank entity is going to sell 3.4% stake via block deal today. The offer price is 335, a 3% discount to yesterday's closing price, and the deal size is $100 million. But I believe there is an upsize option as well. So looking at demand, we'll have to see how it goes. The execution will be important from a stock point of view, because if it happens in the block window, that means no leakage and will be a less than 1% discount. So it might happen in the green. But if it happens in the open market, then you might see some selling pressure. But largely, the overhang, supply overhang is likely to continue, because even after today's 3.5% stake sale, SoftBank will continue to own 15% stake. So that supply overhang will be a concern. but execution will be key as far as deliveries block is concerned.
Right. Thanks very much, Nimesh, for that. So delivery, $100 million block with an upsize option is what we have. Now, Federal Bank maybe in focus. I think there was an analyst meet there. And the other one is HDFC. Abhishek is standing by on both those. Abhishek, morning.
Morning, Prashant. So, Federal Bank has sounded very optimistic in terms of the business momentum going ahead in the analyst meet that they had yesterday. So, the key highlights is that the incremental ROA levers have been spelled out, how they'll achieve, better ROA than current profile has been mentioned to the analyst community. So, 100% incremental network expansion outside Kerala is what they are focusing on. And they are also focusing on data analytics, digitization and partnership, which will be common theme across the verticals. So management is optimistic on business drivers going ahead. The retail strategy is that digital at the fore and human to the core. Improved granularity is seen now in their wholesale business or the wholesale portfolio. The key focus area is to improve the high margin asset in their loan mix, which has improved from 17% to 20% now. The focus will be over here to improve the net interest margin going ahead. For SDFC Limited, they have increased the PLR or the prime lending rate by 25 basis points, and you also have the council which has given a no objection to the merger of SDFC Limited with the bank. This was the NCLT hearing yesterday. Back to you.
Okay, thanks a lot for that, Abhishek. Well, let's go over to Vivek now. He has some more stocks in the news. Vivek, over to you.
Well, good morning. A few stocks on the radar. First on the list is Bombay Burma. We don't talk about it much often, but the company has made a substantial sale of some of its coffee plantations. So it's going to sell 7 coffee estates to Orange County Resource, and the total sale consideration is pegged at over 290 crore, and it will come via multiple tranches. Other stock on the radar is Power Grid. Some positive news flow. The company has been declared as the successful bidder, and this is for an interstate transmission system that will begin from Gujarat. This particular order win or this particular bidding was won under the tariff-based competitive bidding program that is actually there, and it is going to be done under the BOOT basis. Last stock on the radar is MOIL. Now, manganese ore grades, various grades. Prices have been increased by the company, almost 8% increase in various grades, and also along with that, the EMD prices, that the electrolytic manganese dioxide prices, have also been increased by 2.6%. Some positive news flow coming in for MOIL as well.
Thanks very much, Vivek, for joining in and filling us with that list of stocks. But Sonal joining us because she's tracking more stocks that are in news this morning. Morning, Sonal.
Good morning, Nigel. Well, a couple of these real estate names that operate in the Mumbai region, because we got the Mumbai registration data for the month of February, and there has been a fall on a YOY basis, 11% lower at 9,268 units, but it is up 3% on a month-on-month basis. So if you just look at the trend, it has been falling from it after rising for a couple of months. It has seen a fall in the month of February 2023. A Knight Frank says that more than 80% of the increase in stamp duty collections, so stamp duty collections have come in higher. That is because of sales in high-end apartments. Now, this could be because of that new budget amendment that had come, which capped capital gains to 10 crore rupees in case of a sale, and it is applicable from 1st April. So ahead of that, we are seeing higher sales in the luxury apartment segment as well. Earlier I had spoken to some of the real estate players. They had said that the demand in the less than 40 lakh category is starting to see some weakness because of higher interest rates. So there could be some impact of that. So while the revenues or the stamp duty collections are higher, number of units sold or registered have fallen, and that's why some of these stocks will be in focus today.
Okay, demand in less than 40 lakh segment is relatively weak, but demand in 7 crore and above flats is soaring through the roof. That's the way the economy has been lately. But here's a quick recap of our top stocks. Stocks with positive news flow are Axis Bank, Bombay Burma, Power Grid, MOIL, Federal Bank and HDFC. While stocks with negative news flow, Delivery, Macrotech Developers, Oberoi Realty and Keystone Realtors. Well, let's also talk about the macro cues. We referred to them a while back. The GDP growth in the third quarter slowed for the second consecutive quarter to 4.4% versus 6.3% in Q2 and versus 4.7% forecast by our poll. But that's more because the FY22 and FY21 GDP numbers have also been revised higher. Lata is here with the key takeaways. Lata.
Well, that's the point. 4.4 is not a number we will be very happy about, but the point is the Q3 earlier and the Q3 before that was so strong. They were coming out of lockdowns and Delta waves. And therefore, on that base, maybe we shouldn't grumble too much about 4.4. And as if to give us evidence about the previous year performance, both the years, GDP has been revised very sharply higher. FY22 GDP has been revised higher by nearly 2 trillion rupees. It was 8.7 we thought to growth, it's actually 9.1. And the year before we thought was a minus 6.6, it's actually minus 5.7. That's a huge revision, 90 basis points higher revision that we're seeing in growth. Now, what about the internals of Q3 itself? What worked was the services sector. The big one we call trade, hotels, transport, communication, broadcasting. That grew well at 9.7%. It was expected to because it was dormant for the past 2 years. Then construction has done exceptionally well. We can see it in the cement usage and steel usage. And likewise, utilities, power, gas, all those that we use on a daily basis. That's also grown 8.2, showing very strong growth. What didn't work? Manufacturing, terrible, minus 1.1. We were prepared for that. We were even expecting minus 2%. And that is quite clearly a weak consumption, weak exports, high raw material prices. Public administration, whatever government does, schools, defense, all that, even that didn't grow much, 2%. We know that the government is trying to reduce fiscal deficit. But if you look at GDP from not the output, but from the expenditure side, then you get the disappointment. Personal final consumption expenditure has slowed to just 2%. And we know that. I mean, we heard it from all the FMCG companies. We know that rural demand consumption didn't pick up. And that's, a terrible number. Government consumption also didn't compensate. It was minus 0.5. What worked really was capital expansion. Excellent gross fixed capital formation, 8.3%. So hopefully productivity in future years will grow up. But we should worry about consumption slowdown. Now we have to do 5.1 in the fourth quarter, current quarter, to reach 7%. Looks like a tall order given the kind of slowdown we are seeing in consumption, given the global slowdown as well. So slowing we are, but there are some positives in this GDP number.
Okay, Lata, thanks a lot for that. Consumption slowdown. I think, that's a phrase, that's a narrative that's been ongoing for a while. And now this data corroborates that. Thanks for joining in. Well, oil has rebounded almost 2% on China growth hopes. Oil is back at $84 a barrel. Manisha Gupta joins in for a quick roundup of all the action there. Manisha, good morning.
Oh, well, absolutely. This is one data that the street was watching for, and with the takes in China PMI numbers coming in at 51.6 versus 49.2 in the month of Jan, which is the first improvement in 7 months. Markets clearly have taken it very, very positive. So not just a jump in crude oil prices, which is up 2% overnight, but we also have seen the natural gas prices gain up by 2% in last 2 days, 1% up in the Asian markets. It's how it's trading right now. Add to that the fact that the OPEC output has continued to decline. The U.S. crude production also is the lowest since August 2022 at around 12.10 million barrels per day. So all of these factors clearly supporting the markets. For gas as well, after almost a very weak, second half of Jan to first half of Feb, the last couple of weeks have now started to see a drawdown in case of gas in US and Europe as well, and that seems to be supporting the prices. After hitting a low of 1.97 MMBTU, we are trading at 2.27 right now. So strong gains coming in across energy sector, and the base metal price is also trading in the positive after the Chinese data.
Okay, all right. Thanks a lot for that, Manisha. Well, time to slip into a short break. When you come back, we'll get chatting about stocks. We'll get fundamental analysis going with Deven Chowksy of KR Chowksy. We'll also be joined by the management of Mastek post that deal that they have done with Nitel. Stay with us.
Welcome back to Bazaar Morning Call. Well, plenty of stocks in focus. Let's talk about some of them. Now, the auto stocks are all set to announce their sales numbers today. But there's also a very interesting note that CLSA put out on M&M. So just want to talk a little bit about that. CLSA has upgraded M&M to a buy from an outperform, and they've raised their target price to 1,619, which is a big upside from the current market price. Now, it's the same old set of reasons. They're saying that the momentum is very strong in both the farm and the auto business for M&M. They're expecting the SUV volumes to see a 20% growth in the next fiscal, which is FY24. Their order backlog is very strong at 266,000 units, and they have 6 new electric SUVs coming out over the next 5 years. In fact, the order book is so strong that they are now increasing their capacity as well to 49,000 units per month to serve a rising demand. And on the tractor side too, they are expecting about a 13.6% volume growth in FY23 because of a strong winter crop production as well as prices. But the only caveat here is that the expectation is that the El Nino and the weak monsoon could perhaps derail the tractor segment. Let's see. For now, there's a big upgrade that's come through. Deven Chowksy of KR Chowksy Securities joins in to talk about that. Deven, this is one stock that you've liked, you've tracked for very long. But do you think, this whole monsoon situation could derail the growth in the stock as well as the tractor business? Or are you confident that the strong auto segment can offset that?
Good morning, Sonia. Auto segment certainly, I think, is going to play a very important role in M&M space because of very significantly high amount of waiting period that they are having in some of the major category of vehicles, including, I think, in some cases, 60 to 65 weeks of waiting period that they have in XCV 700. So definitely, I think auto segment is something which is giving you a complete visibility for next 1 year, 1.5 year, 2 years. That is, I think, definitely going to play a major role. As far as I think the farm equipment business is concerned, I think if monsoon trouble comes in, then possibility of I think you might see some amount of I think volume getting lost in this particular case. However, given the kind of structural reforms that the country has adopted, including I think in the area of cooperatives, my reading says that I think in the farm area of business, I think particularly the business activities are going to be on rise. If the monsoon factor plays some role, I'm just using this particular thing. Then in that case, some amount of subduedness may be experienced. And that could possibly affect, I think, every other company, not only M&M. So I think one will remain a little bit watchful on this aspect. But otherwise, I think the company looks absolutely strongly placed on both these segments at this point of time.
Okay, all right. Hi, morning, Devin. Good to speak to you in the morning. Well, Devin, tell us about Axis Bank. The stock has seen a correction from the recent peak, but they've gone ahead and completed that Citibank acquisition, which is good news. What's your view on the stock from here on and your view on the deal?
So, good morning, Nigel. The deal definitely remains positive as we have talked before. I think both on acquiring higher amount of deposit as well as I think incremental advances, I think which would come along with this card portfolio. That is definitely, I think, going to work positive for Axis particularly. And I think this business remains high-yielding business for the company. So from that perspective, the deal getting absorbed and the activities now forming part of Axis is definitely a good news. Maybe I think in 1 or 2 quarters, you might see some exceptional expenses, I think, which they may have to incur due to this particular merger that they are doing or the acquisition that they are doing. That might, I think, reflect into the books, but it's not going to be, I think, major chunk of money as I see it. Overall, the environment remains quite conducive for the banking sector as a whole. The corporate lending book is remaining, I think, one of the strongest proposition in recent quarters. Despite of hike in the interest rate, I think we are also seeing the growth in the retail book and the housing finance book for most of the lenders. In my viewpoint, I think given the kind of strength that they have for the lending and also the better ability to manage the liability side with the CASA ratio, I would think that I think overall picture should remain intact. Maybe because of the market condition or technical weaknesses, you might, I think, probably see less participation at this point of time into this stock. But otherwise, I think the business-wise fundamentally, the companies remain absolutely convincing at this level.
All right. I do want to talk a little bit about the mid-cap IT space because there's lots happening there as well. A lot of these companies have come back in a big way. So, Devin, request you to just stay on. We have one IT company joining us now. In fact, Mastek, the first corporate that we're speaking to this morning, the company, remember, signed a strategic partnership with Netail to bring AI-led digital transformation to the retail and consumer industry. That's the buzzword as of now. So to understand the potential from this deal and what the outlook is, we're joined by Ashank Desai, the Vice Chairman and Managing Director at Mastek. Ashank, thanks a lot for joining in. Can you tell us a little bit about the details of this partnership? And, what would this mean in terms of revenue contribution? Any kind of revenue share that you're looking at? How will this boost your retail business?
Yeah, Sonia, thanks for the invitation. Thanks to be here. As you know, Sonia, we have been focusing on digital marketing as a major segment of our business. It accounts for 22% of our business. And on that, 15% is a retail business that we have. That means retail digital marketing. We have been doing it through Oracle relationship that we had on digital marketing and now Salesforce. We acquired this company MST, which is focused on Salesforce. And both of them are giving us a big boost in the retail market. Now, what's happening in retail market is almost complete change in consumer behavior in terms of how they buy. 90% of them go through a search engine and they look at all kinds of prices and so on and so forth. So our customers are looking for something beyond digital marketing from Salesforce and Oracle that we already have. And this Netel is exactly filling that gap. What it does is it looks at search data, it looks at competitive data, it looks at pricing, and not only gives you information, what it gives you is recommendation based on AI. And they have seen that as a big boost to their retail consumers. So when we go with them, we will now have a better offering in digital marketing space for our customers.
So
Which means we have
Sorry, just to understand how the retail business is functioning at the moment, I think in Q3, retail was up 7%, but on a quarter-on-quarter basis, it was down 8%, if I'm not wrong. So there were some furloughs as well, quarter-on-quarter, that you had to face. So just trying to understand, in retail particularly, have you seen a ramp down or a slowdown as far as deals are concerned?
Can't say specifically retail versus other sectors. There has been delay, obviously. The decisions are getting delayed because customers are now looking at whether they should do more offshore versus less on-site, and obviously some worries about recession and so on. So there is a decision place today, and that is true for all. So I won't say retail is the only place where there has been a delay specifically.
Okay, all right. Hi, Mr. Desai. Good morning. Q3 was a little bit softish for you on the organic front. If you include the Metasoft acquisition, then there was some growth. So tell us, how is Q4 shaping up? Do you expect some growth first organically, and what about including this acquisition as well?
No, this is not an acquisition. This is a strategic tie-up.
No, I'm referring to Metasoft, sir. Metasoft, organically, how are things shaping up since Q3 was slow? So how is Q4 shaping up? And if you're giving us for the consolidated entity, then including Metasoft, how is it shaping up as well? Go ahead, sir.
As we said last time, Metasoft business is doing quite well. In fact, better than what we thought. Not only that, our Salesforce business is growing fast because of Salesforce's own initiatives in US, but it is pulling us in UK also. So that side of business looks quite good. On the organic side, as we said in our calls, we have focused now to look at various components that we initiated during last 2 or 3 quarters. And the results we are looking forward to see in this quarter. Obviously, we don't give any guidance, as you know. So it's difficult for me to talk about specific numbers, Nigel. But the point I make is one engine, which is organic side, is also now we are focusing on moving up this quarter.
Okay, all right. Okay, Mr. Desai, I wanted to ask you on 2 aspects. One is margins. After 7 quarters of decline, there was some stability in the past quarter. So that's good news. What is the margin band should we be working with from here on? And also, attrition has cooled off quite a bit. Worst of attrition behind? Any kind of number you could give us on attrition and margins?
See, as far as attrition goes, it is going down, but still, to be honest, not going as fast as we would like to have. It is going down, but we are looking forward this quarter. Again, there will be fall over last quarter. However, I think the speed of attrition has to still go down faster. Hopefully, we are looking at next year, the attrition will come back to the normality is what I'm hoping for as far as attrition goes. And we have talked about EBITDA margins in the range of higher teens or moving beyond, the higher end of the teens. And I think we will retain that. We had, of course, higher than that EBITDA margins in the previous year, but we feel that we will maintain what we have talked about in our guidance and the investor call after the results in Q3.
Okay. All right, Mr. Desai, we leave it at that. Thanks a lot for joining in, and hopefully things will improve the next time we speak. That's Mastek talking about the recent partnership. But I think what stayed with me is their comment that decisions are getting delayed as customers are worried about recession. So that seems to be the problem area for the IT space. Let's slip into a quick break. On the other side of the break, it is 8:45, so we'll get our technical experts in to tell you what to expect from the market today. Looks like it's going to be another weak start. On the other side, Anuj will be joining in for a quick trade setup as well. We'll bring you the top stock picks of the day from our technical and F&O experts. Prashant will bring you the Market Laser, a segment where we analyze stocks and sectors through a technical lens. And later, we'll decode the stock rally in our Momentumizer segment. At 9:10, Nimesh will be there with the standout brokerage report of the day. And before the market opens, in CNBC TV18 Stocks Board, we'll highlight the top stocks in the news to focus on for the day. Stay tuned.
Welcome back. You're tuned in to Bazaar Morning Call here on CNBC TV18. Well, Anuj joins us in the studio as well. Anuj, 8 straight sessions on the trot that we are lower. What's your sense today? Do we see some bit of relief?
Morning, Nigel. The hope is that it's not the 9th, but hope is not a data point, right? But still, the one hope that the market has is that Bank Nifty has turned. And that's been showing some resilience for the last 2 or 3 days. Look, this has been a delight for positional shorts over the last few days, especially on the Nifty. But the big question is, have we reached a stage where the risk reward is not in your favor to now take fresh shorts? 16,800 to 17,000 anyway, I think is the last sort of zone in which you will have some buying also emerge. The only problem for the market now is that the market leadership pocket, which is IT, has turned decisively. Mastek has broken or is close to breaking 50 DEMA. The Nifty IT is close to breaking it. It has already broken it. And the market is back to old economy stocks. Banks have started to do well again. FMCG is doing well. Power stocks are doing well. So that's been a bit of a hope. On the Nifty, the texture still remains sell on rally unless told otherwise. But for now, my sense is that if you start to see some buying at lower levels, then maybe there can be some short covering, especially given how banks and FMCG have behaved. But I think the best trade right now is in the Bank Nifty because that's clearly showing you signs of bottoming out. And if the recent low holds, that perhaps could be an index which over the next few days becomes buy on dips instead of sell on rally because it's been quite resilient. It's not breaking 40,000 on closing basis. Though today we need to see how HDFC Bank and Axis Bank react to news, especially in HDFC Bank because in last hour yesterday there was quite a bit of buying. So there was some pre-positioning which was taken. But nonetheless, banks all of a sudden have started to show some resilience. And one more point, yesterday, the broader market was doing quite well. The mid-cap index was comfortably in the green. And that is also something which would give comfort to the bulls that maybe we are closer to the bottom than we ever were last 3 or 4 days back.
Okay, all right, Anuj, thanks so much for that. By the way, guys, before we move on, I think that block deal has taken place on delivery. Those 2 crore shares, they have changed hands, so I think we should get some of those details up for you. Nimesh was hinting that it could possibly happen in the block deal window, and that's precisely what's happened. So we'll try to get you more details on that front. But let's move on and get in our technical guest. We have Sudarshan Sukhani who joins us on the show now. Hi, Sudarshan. Good morning. Well, Sudarshan, you go first. You tell us what are the strategies, and then, in fact, we'll go back to Mitesh as well. Go ahead, Sudarshan.
Good morning. See, the Nifty broke down that 17,400 support level decisively yesterday, and it closed much below it. So this was a trading range for 1.5 months. That range has broken on the downside. This is not good news for buyers. This is not good news for the bulls. So for today, I would suggest that until 17,400 is reclaimed, the trade is to sell on rallies or sell on minor intraday rallies. Your stop should be just above 17,400 and see where the market goes. Now, we all understand that the markets have been, are now currently in a sell mode, but they are deeply oversold. But they can remain so. So till 17,400 is not reclaimed, avoid buying, look for intraday short positions. Now, the Bank Nifty is a different story. As Anuj just said, the Bank Nifty is actually giving a buying idea. It's still a buy with a stop above 39,800. So we have 2 different contradictory views on the Nifty and the Bank Nifty, but that's how the market is.
Yeah, no, absolutely. Gentlemen, good morning. Mitesh, what about you? How are you looking at things this morning?
Morning, Prashant. We kind of cut our positions day before yesterday, majority of short positions when we kind of saw the market recover and close above the 200 average. And we got a hammer pattern, but then the high of day before yesterday was not taken out, which is Monday's high. And then we actually broke below yesterday's low. So we have some put options positions. The overall structure is weak, but then about 8-9 sessions of red candlesticks means that there's always a chance of a pullback happening. So I think selling in the index, particularly Nifty, I would prefer put options Futures, I think I would want to go into it if we get bounce back closer to about 17,400. And beyond 17,450, there might be a stronger reversal. So I think 17,450 will then become your stop loss for short positions on the futures side. But otherwise, I think, not much index exposure, to be honest. Trading with stock-specific biases. And again, while there's a mixed set of positions, there's a mild, bias towards the short side.
Bias towards the short side, sell on every rally is what Sudarshan said as well. So let's get some individual stock ideas then. Sudarshan, where do you see the largest pressure pockets and what are the stocks that you would buy today? I mean, what's on your list?
See, there are stocks that are actually beginning to go up. So Colgate is one of them. It was in my list earlier when I said it's just on the verge of breaking out. It has broken out on the upside after a long 2-month trading range. So Colgate is a buy with a stop under 1450. Bajaj Finance is my only intraday short. The stock had decent rally and now it's giving up all the gains day after day. So that's an intraday short with a stop above 62.50. Polycab has been an outperformer. From 2,500, it has reached 3,100, even as the Nifty was steadily going down. That outperformance should continue. Buy with a stop under 29.75. And another outperformer is Ultratech Cement. See, Sonia, there are stocks that are actually going up, and that always happens. Even in a bear market, stocks go up, some of them. Ultratech is a buy, the stop under 71.60.
All right. Those are individual trades. Sudarshan, thanks for that. Mitesh, what about you?
I have 2 buys and 2 sells. ABB is a buy with a stop at 31.90. A target of 32.85 can be looked at from a trading point of view, though I suspect the medium-term chart suggests more upside over here. And some reversal happened in the paint stocks yesterday, and we had picked up Berger Paints earlier as well. Now can be bought afresh with a stop at 569 for targets of 600 on the upside. And a couple of sell calls. The pharma stocks have been corrective led by Sun Pharma and Cipla, and I've chosen Sun Pharma as a sell call today. 968 is the stop loss, 930 is the short-term downside target, and a reversal or a pullback happening on the charts of Apollo Tyres, which is a sell with a stop at 318.5 and a target of 302 to about 303 on the downside can be looked at.
All right, let's do one thing. Let's take a quick commercial break. On the other side, we'll have the pre-opening rates kick in. We'll also have Nitin Agarwal of Motilal Oswal Institutional Equities to talk about the banking sector, as well as Axis Bank's acquisition of the India consumer business at Citi.